Dividend investing. This is a strategy of investment that can truly pay you passive income and even build generational wealth if you're diligent enough. However, there's a lot to discuss about this subject that you need to know before you go ahead and jump in. So let's discuss how dividend investing works, the best strategies, and how much money you can actually make with this strategy. So to start off, we need to define what is a dividend. A dividend, put simply, is a portion of a company's profit that is distributed to shareholders, those who own the stock of that company. So if you own 10 shares of Apple, you're entitled to dividends for those shares every year, although dividends are typically paid out quarterly. So your dividends for those 10 shares would be broken up into 4 annual payments. Now, how do you find out how large these passive income dividends will be? Great question. All you need to do is look at the dividend yield. Looking at Coca-Cola's stock, a Warren Buffett favorite, at the time of recording this, their stock is valued at $57. Now, below the price is the dividend yield. This is typically just below the price on any platform you use. The dividend yield is always provided and always fairly easy to find. So as you can see, Coca-Cola's dividend yield is 2.98%. And it's worth noting that there won't always be a percentage sign next to the dividend yield, but just remember it is a percent. So all you need to do is find out what 2.98% of the stock price is. So $57 times 0.0298 gives you 1.7. This means for every share of Coca-Cola that you own, you would receive $1.70 every year just for owning that share. However, it's important to note that dividends can increase or decrease over time depending on how the company is doing. Now, what is dividend investing? Most established companies pay dividends. It's just a matter of how much they pay. Dividends can range from a fraction of a percent all the way up to 6 or 7%. Dividend investing is a strategy where you target investments with a high dividend yield. You do this in order to create an income stream of dividends, passive income. And then you either pocket the money and buy something shiny, or you reinvest the dividends into more high dividend investing. That way you get this snowball effect where it's just growing and growing over time. The true power of dividend investing comes from reinvesting those dividends, not pocketing the money and buying something shiny. Because when you reinvest your dividends, the magic of compound interest is going to make you a whole lot richer than if you didn't. Now, I need to thank the sponsor of this video, Webull. I have been personally using Webull for more than a year now, and I use them to buy stocks, and I'm a big fan of the platform. So here are some of the top features of their platform. First off, zero commission trades. Second, multiple investment functions. They offer a huge variety. You can buy or sell stocks, you can buy or sell cryptos, you can buy or sell ETFs, options, fractional shares. Basically anything that you would want, you can pretty much do on your Webull brokerage. And they have the best charts in the game. Back when I was doing daily live streams, I used Webull on every single live stream because the charting is so much better than any other brokerage I use. I was able to use that to present to my live stream viewers what exactly was going on. And if and when I start live streaming again, I will use Webull for the charting as well. And also, they are the best way to get free stock. So they're running a promotion right now. They've actually made it even easier than ever before, where if you deposit $5 into your Webull account using the link down in the description, you'll get 1 free stock just for making an account. You'll get another free stock after that $5 deposit settles, and you don't even have to spend the $5. 2 free stocks. I mean, that's an ROI that you can't really get anywhere else. Now, before we look at a real-world example of what dividend investing would look like and the power of dividend reinvestment, here are some recommendations on dividend ETFs. The value of a dividend ETF is you get a ton more diversification. If you buy AT&T stock because of their hefty dividend, but AT&T has a bad year, your portfolio is going to be hit hard. With a dividend ETF, you can get this diverse basket of dividend stocks. This means if any individual stock within that basket does poorly, you will barely be affected. Dividend ETFs with the highest yields are first, the SDIV Global X Super Dividend ETF. Their current dividend yield is 8.56%. And second is the DVYE iShares Emerging Markets Dividend ETF, and their yield is 8.21% currently. Now, dividend ETFs with safer holdings but lower yields are the VYM Vanguard High Dividend Yield ETF with a 2.79% yield, and the DYV iShares Dow Jones Select Dividend ETF with a current yield of 3.8%. But always make sure before you buy an ETF to take a look at the prospectus and check out their holdings and make sure that it aligns with what exactly you want. Now let's do a real-world example of dividend investing. So you set up a brokerage account, maybe with Webull, link down in the description again. You've picked a couple dividend ETFs that you're interested in, and maybe even a couple individual companies as well. Let's look at the actual numbers and see what kind of returns you could expect. As you can see in the ETF recommendations that I gave, the yields on high dividend ETFs can range anywhere from 2 to 8%. So for sake of example here, we're going to use 5% dividend yields in our calculations. And then we'll add yearly stock growth of 3%, as dividend investments typically don't increase in price a whole lot, so we'll stay conservative with 3%. Let's say you invested $500 per month for 20 years at a dividend yield of 5% and never reinvested your dividends. You pocketed all of your dividends so you could save up for an LK enhanced easy H2O bottle filling station. And then after 20 years and $120,000 invested, your ending balance would be $259,000. That includes all the dividends you pocketed over time. Now let's say you did the exact same thing, $500 a month over 20 years at 5%, and you reinvested all of the dividends. Your ending balance would be $295,000, so 14% more, which may not seem like much, but your upcoming dividend payments are now double what they would be if you hadn't reinvested, because all of that $295,000 is still invested and making you even more money. Now that we know our dividend payments are much larger if we are reinvesting, let's see the effect if we wait even longer. So let's say you do the exact same investment plan, $500 per month, 5% dividend yield, but instead you wait 40 years. We can now see the snowball effect of reinvesting your dividends. After 40 years, if you hadn't reinvested the dividends, you would have $968,000. If you'd reinvested your dividends, you would have $1.87 million. Almost double, but that's not even the best part. Now your upcoming dividend payment is 4 times what it would be if you hadn't reinvested those payments. And as you can see, this is a massive difference if you reinvest your dividends, which is why dividend investing is so popular. And this continues to snowball so fast that if you passed your account onto your kids and had them reinvest for another 40 years, so 80 years in total, the balance would be $114 million versus just $6.5 million if they hadn't reinvested dividends. Now we can see what dividend reinvestment and the power of compound interest is capable of, building generational wealth if you're committed enough. And it's worth mentioning the difference between dividend investing and growth investing, the other popular strategy to take advantage of compound interest. Growth investing is when you invest in companies or ETFs that may not pay high dividends or even dividends at all, but have a lot of room to grow in their industry, where they're focusing on growth of the share price versus paying out dividends. So while dividend investing can compound on itself if you reinvest those dividends, growth investing compounds naturally, although they both have their own pros and cons. The two major differences between growth investments and dividend investments are growth potential and risk. So there is a whole lot more growth potential in growth investing, as implied in the name, where dividend investing can only return you so much. But of course, there is a downside to having more upside potential with growth investing, and that is risk. We all know that risk is directly correlated to reward. So while growth investing has more upside potential, it can be significantly more volatile and have less of a guarantee when it comes to returns. Well, with dividend investing, because your return is based on the reinvestment of dividends, you can target ETFs and companies that have a long history of paying dividends reliably. This way you can have a much more reliable investment in the long term. It's also worth noting that with dividend investing, you never have to sell your investments, as you can just reap the benefits in the form of dividend payments whenever you're ready to retire. Well, with growth investing, you may get hit with a fat tax bill all at once when you decide to retire and sell off your investments. But of course, those investments can be made in a retirement account as well, so you can limit tax exposure if you're planning on buying a growth company to then later sell for retirement. Now let's talk about what your portfolio could look like. You're ready to start investing, but what should your approach be? It all depends on how much risk you're willing to take. If you're young and you have no plan of retiring or liquidating your investments anytime soon, then an option for you could be 30% of your portfolio in high dividend investments and 70% in growth investments. If you're older and approaching retirement, you may want to do something like 90% in low risk dividend investments and 10% in growth investments. Now, the ideal portfolio ranges wildly depending on who you ask. So you just want to make sure that your portfolio aligns with your risks and your goals and your lifestyle in the long term. And at the end of the day, any investment is better than not investing at all. And for every ounce of risk you take on, there's a pound of potential reward. So figure out how much risk you're okay with and then go from there. And that's going to do it for today. I would like to thank you so much for watching, and I hope you have a profitable day.